Hi, and welcome back again to Tim Bigham's Options and Volatility newsletter. We'll once again be taking a look at why IV matters, why implied volatility, in my opinion, is by far the most important concept in option trading. Obviously, of all the option inputs, IV is the only unknown, right? Hence the term implied volatility, which is the volatility needed to make the option price match where it's trading in the market. So we'll be taking a look at OKTA in this instance, which is a kind of a nuclear related sort of stock, right? And certainly with nuke and every power stock racing higher here because of the AI boom, right? Power needs will go through the roof. Certainly OKTA has benefited from that. And we're seeing big repeat unusual call buying, which has driven the price of the options to extreme. So we'll take a look how to take advantage of it in a bullish and neutral fashion here. So let's jump in and take a look, shall we? Here is one of these scanners I use that I built on Thinkorswim. You can see from Friday OKTA with several options making the list here. And the basic input to this is unusual option activity that moves the implied volatility surface at least 3 vol points. So you can see OKTA fit the bill here. Another scanner that I look at, here's OKTA right in the top, first page of this, right, as far as a jump of over 12% on IV, as you can see here. Also, 115,000 almost contracts traded versus an average of about 20, and this has gone up recently, right? So this sets up ideally for a couple trades to capture that IV. Taking a look, here is the 60-day IV, right, which is now reaching about the highest level it's been over the past year. You can see every time it gets up to this level, right, it almost invariably reverts back down. You can see from Thursday to Friday that IV moving up as well. So implied volatility, which is a fancy way to say the price of the option, right, getting extreme here. Here is the Thinkorswim. Look at it. You can see of the options about a 5-to-1 ratio calls to put. So calls certainly being favored here. And this has been kind of the way with these kind of meme or, if you will, AI related names. Lot of call buying and implied volatility now over the 50 percentile, right? Given the fact that the VIX is nearing yearly lows, it makes it even more important, right, that IV is so high here. You can see here's that big volume. August, certainly the Julys we can kind of disregard. Normally you're seeing these very short-term options get the most volume as the big speculators rush in, but out to August, right, you can see the vol jump there as well, and at later months as well. Here's a chart, right, of the 60 and 90-day slightly out of the money call IV. You can see just recently here's where that call volume started, that huge uptick, right? This is over the past 30 days. So just looking for a revert back. Doesn't have to go all the way back down here to where it was before, but just looking for it to come down, take the trade off and move out on that reversion. So several ways to take advantage of it. For those who are approved to the basic option level, right, and can only do covered calls, certainly covered call trade makes a lot of sense here. So I went back to the last time OKTA was trading at basically this price, compared it to Friday's close, right? So June 9th, right, OKTA at 101.20, right, the stock close, and took a look at, here's a simple covered call, right, selling the 110 call. So you have about 8% or so upside still, right? In this case, 67 days to expiration, and you can see that covered call trade back there, right, selling the call at about $2.80, buying the stock at 101.20. You would have paid about 98.40 or so net on the trade, selling a 33 IV. Fast forward to Friday's close, stock virtually the same price, right? 101.10 versus 101.20. So a dime on $100 stock doesn't mean a heck of a lot, right? But you can see the call price now has basically almost doubled, right, to $5.35, give or take, versus back here, right, it was trading about $2.80. So the fact the stock is a dime lower, right, and the calls are almost double the price, sets up ideally for that covered call. IV now at well over 50. Before it was trading right around the 33 area. So IV has absolutely leapt higher because of this big repeat call buying that we just saw on those scanners out there. So you can see that drove the price of the covered call, right? Buying the stock, selling these now very expensive options. We got the stock a dime cheaper from back there in June 9th when it closed at virtually the same price. But more importantly, we're able to pick up about $2.50 more on the calls we're selling. And note too, only 55 days to expiration. I did this by design. Option prices less time should make them cheaper. In this case, versus 67 back the last time was here. So 12 days less, yet the option is that much more expensive. Why? Because this big repeat call buying has made IV explode, making option prices much more expensive. So for those with the basic option approval level, a covered call here certainly makes sense. You can get in $2.50 cheaper with less time to have to wait on it and still leave plenty of upside on the trade, right, as we're selling slightly out of the money calls. For those who just like to capture the Vow, same sort of thing here, right? Took a look at the iron condor trade, which is defined risk. So selling the 115-120 call spread, and at the same time, the 90-85 put spread, both out of the money with the stock at 101.10 on Friday's close, right? You're looking at the call spread being about 14 points out of the money. The put spread, right, about 11 points out of the money. So basically equidistant, right? And you can see that iron condor selling both spreads, you could have sold it for about $2.20. You're risking max 5, right? Less the 220 you receive. So you're risking 280 to make 220 as long as OKTA stays above 90 or below that 115 level come expiration in 55 days. Go back to the last time the stock was trading here again, 101.20 versus 101.10, and that same iron condor, right, only trading at $1.45, so under $1.50, well over $2 here, more time to expiration, 12 days order expiration. It should make the trade more expensive, but because this big repeat call buying, right, exploded that IV, as we took a look at here, right, we can see this jump in IV simply exploding that price of the puts and calls both. That iron condor defined risk trade, right, you can certainly get a bigger return, right? So in this case, right, back then you'd be risking $1 or bringing in $1.45, risking $3.55, right? So certainly your risk return, right, would be much less, right? So if you're risking $1.45, right, 145 divided by that 355, right, that gives you a 40% return. But looking where it is now, you're risking or bringing in 220, we'll call it, and you only have 280 at risk, right? That would make that risk return much greater, 78%. So almost a double risk return profile simply because IV has exploded. So this is a way to take advantage of this huge jump in implied volatility as well. To follow that big call buying out there, certainly you don't want to really go out and buy these expensive calls. Selling a put spread is an easy way to do it. So I simply took a look at the last time it was here on June 9th, stock at 101.20. The out of the money, the 90-87.5 put spread, trading just under 50 cents. Fast forward to Friday's close, right? Stock again, a dime lower, right? But shouldn't affect this well out of the money put spread, which is over 11 points out of the money. More time to expiration back then, right? 67 versus now, so shorter time frame. That spread should be less expensive, but it's more. You can get well over 70 cents. Why? Because IV lifted across the board for both the calls and puts. And for those approved for naked options, right, you might want to forego the iron condor, which is defined risk. You're buying the protective 85 put and 120 call. If you just want to go out and sell the strangle, you can see on Friday that sell strangle selling the 125 call, right, and the 90 put, giving 11 points of downside cushion, right? And over 24 points of upside. And certainly with this kind of stock, a lot of people are thinking there's going to be a huge upside. You could get almost $6 net credit, selling well over a 50 IV on both. And please note too that the calls are trading at a higher IV than the puts. That kind of gives you that it's getting maybe a little frothy out there on the option prices as well. Going back to the last time I was here, stock at exactly almost the same price, right? That same sell strangle, right? Selling the 90 put and the 125 call, but more time to expiration, 12 days more. You could have only gotten about $2.40. So you're getting more than double the price now to sell that strangle. Why? Because of this huge call buy that has just made option prices extreme. So this is a way to kind of just lean neutrally, right? Just looking for a reversion. So selling a 19 delta here and selling a 10 delta here back then, you would have been actually 9 deltas net long back on June 9th. And note, with the stock at virtually the same price, but IV much higher, right? You're selling a 25 delta, right? And selling a 21 delta, you're only 4 deltas net long. Why? Because these big jumps in implied volatility pull the absolute value of the deltas towards 0.50. So out of the money calls have a higher delta, out of the money puts similarly as well. So hopefully provides insight to how to go about capturing this IV jump out there in both a bullish way, right, with a simple covered call for those who are approved only to the basic option level, or with an out of the money put spread for those who can certainly do spread trades, right, and for those who want a more neutral trade, a defined risk iron condor or a sell strangle for those who are approved to the highest option level for nakeds is the way to play it. So until next time, as always, here's the good trading. Take care.